We did cover this already, I believe, when we looked at the advantages and disadvantages of the income statement. And primarily the advantages are, of course, you have confirmatory value there, meaning that you have the ability to use the income statement to confirm past performance and evaluate it. And you can also predict operating income and cash flows. And this is predictive value. Those are both parts of the relevance. And that's something we have to keep tying together. Limitations, as you would expect. Unrealized gains and losses that would put into comprehensive income will be excluded. We also have problems because of the accounting methods that we use. We talked about income management or earnings management and also judgment. And the big issue for us is the quality of earnings. We want to make sure that earnings quality is not compromised in order to enhance confidence in the market. When we talk about earnings quality, we are concerned with what components of income, and we're going to dig more into this as we move into other modules, what components of income are transitory and what components of income are permanent. And we know that given the judgment, we talked about the problems in terms of, this is the first issue. So we said earnings quality. When you think about earnings quality, what gives earnings a higher quality? Well, first, if the income component is permanent rather than transitory. And the second, you have to look at the subjectivity and discretion that affects earnings quality when management exercises judgment. So we talked about three ways that could happen. When you first choose a standard, when you change a standard from one to the next, and when you apply judgment in applying the standard. So the selection of the alternative and changing those alternatives, which we've already talked about, as well as applying them. Then, just to review, we also talked about the permanent and transitory components. We know that permanent components are typically what you would see in operating income. The transitory components, things like gains and losses on sales of assets and discontinued operations, which we'll discuss. And here are the key bits of information that we need to know that make permanent components more useful. And this is what makes the permanent components a higher quality of earnings. They're likely to continue in the future, so that's going to help you with predictive ability if you're going to continue in the future. They're also, because they are going to be persistent, they're going to have higher earnings quality, and generally these are operating items. The transitory items will affect some of your judgment. It's important to disclose them because of what? Think about the conceptual framework. What would be a possible rationale to include transitory components? And by the way, there have been theories that said that net income should only include the current operating performance. In other words, only operating income. All of these transitory components should be put someplace else, maybe in retained earnings, or keep them off of the income statement. Right? We now have an all-inclusive approach, or a modified all-inclusive approach, which includes almost everything on the income statement. So let's just assume that I'm going to ask you a question, and I'm going to say that I know that these transitory components have characteristics that are not necessarily going to lend themselves to a higher earning quality. They're unlikely to continue in the future. They're of lower earning quality, and they're elements in other comprehensive income and from other special sections of the income statement, which we'll see. So, Brigitte, Joel, can I ask you, why do we include these if they don't have the highest earnings quality? Why would you think we include them? Think about part of the conceptual framework. What characteristics would justify including that? What do you think? All right, so we got relevance and we got faithful representation. So what's in relevance? Confirmatory value, predictive value, and materiality. What about faithful representation? completeness, right, completeness. So I would think completeness, maybe materiality, would be a reason not to exclude those. So the point is, could a transitory component affect your judgment? What do you think? Anyone? What do you think? Yeah, I mean, it could affect your judgment. It could be something that would, let's say, a transitory component, something in other comprehensive income. We talked about this the other day, on Tuesday, with foreign currency translation, right? So you may be exposed to foreign currency fluctuations that could affect the value of your subsidiary. So again, you have to think about tying these together and coming up with a rationale for why things are done. So these are included for completeness. Transitory components are included because they are material, and they could influence your judgment. They could influence your judgment. That's all part of materiality. All right, and then we said that there are income reporting strategies, income increasing, income reducing, and we gave you some of the reasons for that. Management will try to beat analysts or meet analysts' forecasts. You may avoid reporting a loss. You might smooth income. You might want to have an upward trend. You may want to increase compensation if your bonus plan is based on stock price. The other issue, and by the way, when we talk about income smoothing, one of the things you have to remember, let's assume, this doesn't work. So you have a smooth trend of earnings, so that if before you release your annual report in whatever year this might be, 2018, if earnings might drop, you might pick an income increasing standard to try to smooth out that trend. It's also true that if this is the actual, before adjustment, your earnings would take a very sharp turn, and that might be difficult to meet next year. So what do? You might elect a standard that will keep the trend smooth. So you might actually purposely lower earnings to keep the trend smooth. So when we see income smoothing, it doesn't have to be increasing alternatives, it could be reducing alternatives as well. So I know we talked about the big bath accounting, where if you have a loss, you might as well make the loss even bigger. Cookie jar reserves, political costs, higher earnings tend to increase public criticism, may also bring about government intervention, and you may be able to justify price increases, as we said, or force lower earnings or union givebacks in union negotiations. Typically, when there's a transit strike in New York, there could be negotiations for pension plan, for raises, for salaries, whatever it may be, and the transit authority would probably have to show that their earnings are lower because of whatever reasons, but if the earnings are lower, that might prevent getting a higher union contract or higher salary contract. So what will happen, again, you might lower your earnings, you make the adjustment, and this is the reported earnings. So you come down, change your method, and the reported earnings keep the trend smooth or reduce earnings for purposes of perhaps labor negotiations or raising rates. Okay, so that's where we were. Now, continuing, unless you have any questions on any of that. Earnings management. Well, I think I mentioned this to you. I think the most likely source of fraud is on the expense side. And remember, we said what will happen is companies will, once again, you've got that cost. the expense capitalization alternative. Capitalization or deferral. So you record it as an asset first, you defer it, or let's call this a deferred cost. And then you expense it over time. So by expense recognition, what we mean that most of the fraud in accounting, or most of the earnings manipulation in accounting, is coming from the fact that assets are recorded when they really should have been what? Expensed. And there's a couple of examples. I think waste management is one of the examples we use in the book. That company had taken lots of costs that should have been written off as an expense, and they're calling them assets. And they were able to show higher income. At some point it catches up to you, but that is a typical earnings management case. All right. Any questions on the notion of earnings management? We'll see a little bit more of this as we go along, especially with changing accounting methods, when methods have changed. Now, you should know when we look at the current income statement format, these are your definitions of revenues, expenses, gains, and losses. And revenues and gains are the same in that they increase assets or reduce liabilities. Losses and expenses are the same in that they use up assets or create liabilities, so that they are the same. What makes them different is the nature of the item. So remember, expenses and revenues are ongoing, just to review, and gains and losses would be peripheral to the company's operations. We also have different classifications, and when we look at those classifications, we could classify them as either by their nature, that is the source, which would be payroll. Maybe it's coming from depreciation. What's the nature of the expense? I'm also going to tell you, I know I have it down at the bottom, but I'm also going to tell you that I think here you probably should also note it could be operating or non-operating or peripheral. So that's going to be something that we'll talk about in a minute in terms of classification. So operating, non-operating, I think belongs there as well as part of the nature of the item. So is the item recurring? Is it part of your normal operations, or is it peripheral to your activity? That's the nature. Functional. Functional classification is required by the SEC and IFRS. What is functional classification? Functional classification means that we will have selling expense, general expense, administrative expense. So they're looking for, or manufacturing. So cost of goods sold would fall to the manufacturing category. Sales commissions would be part of the selling function. And this again is required by both the SEC and the IFRS, not by the US GAAP standards. So when you look on the income statement, you'll see different ways to classify nature, type of expense. Is it operating? Is it peripheral? Or what's the function? Is it part of the selling function? Is it part of the manufacturing function? Or administrative function? In addition, when we look at the income statement, we also need to think about the current format. And let me just make this a little small because I want it on the screen in one piece. This is the current income statement, and this is from, as I mentioned before, what you might think of as a modified all-inclusive concept. A modified all-inclusive concept, meaning that it includes both transitory and permanent components. As I said, there used to be a theory, there were theories that believed in what was known as current operating performance, which said income statements should only include permanent components. And transitory components should in fact be placed in the balance sheet or retained earnings. So This is our current income statement. You get sales, cost of goods sold, gross profit, and we'll refine this as we move along. Operating expenses, and I want to point something out right now. There's something up here that's called unusual or infrequent items, and those could include impairment losses that could have some transitory elements to it. They're mostly permanent, but there could be some transitory. Sales are permanent. Cost of goods sold is permanent. Operating expenses, generally a permanent component. Computer? Operating expenses? What's that?
Is it okay if I can just take notes on it today? I don't have my
Okay.
Usually I have it on my notebook here.
Right.
Sorry.
Then you've got unusual or infrequent items, so sales of plant assets. You've got impairment losses and so on. Then you've got income tax, coming out income before tax, and then you've got something known as income from continuing operations. Now, this generally divides the income statement between what is from continuing operations and discontinued ops. We're going to talk about discontinued operations. This is going to be the biggest issue in this chapter. How do you account for discontinued operations? And what is a discontinued operation? This is going to be the first exposure you're going to have to applying accounting standards. And this is some of the things that they said. We're just going to cross now. We're crossing into full-blown accounting, where you get these standards, where you get criteria. You got to meet these 2 conditions, these 4 conditions, and you have to start applying those conditions as well. You then get discontinued operations, and notice that it is shown net of tax. So what I want to point out, there is something known as interperiod tax allocation. Tax is assigned to the different categories of income. So you're going to have tax on continuing operations. You'll have tax on discontinued operations as well. We'll look at prior period adjustments that goes to the balance sheet. That has income tax. Other comprehensive income, that has income tax on it. So the income tax is spread throughout the financial statements. And when we look at this term, interperiod tax allocation, this means that the tax has to follow, tax will follow the source of income. So if the income is continuing operations, then the tax is reported on continuing. If it's discontinued, it's reported there. If it's prior period adjustment, that's where it's reported. And if it's other comprehensive income, it's also shown net of tax. So you have to tax affect each separate type of income that you've got. And then the other thing too is earnings per share. Earnings per share is only on net income. There's no earnings per share on discontinued or continuing operations here, but there will be when we make those disclosures. So earnings per share is shown on each separate source of income. So we're going to see EPS on continuing operations and on net income. You could show it on discontinued. You don't show earnings per share on anything above the accountant's dividing line. So you would show earnings per share on net income, you would show it on discontinued and continuing, but you don't show it above continuing, I should say. So nothing above continuing operations has separate earnings per share. So when you get to this in intermediates, you're going to find out that EPS has to be shown on income from continuing operations and on net income. Yep.
You said normally though that transitory items wouldn't be on the income statement?
No, I'm saying under a theory called current operating performance, they wouldn't be. But we now use what is known as an all-inclusive concept. The all-inclusive concept is modified, however, because it's got some items not on the income statement. So on a full, so there are two theories. One was current operating performance, and they would say those that believed in that thought that everything that's transitory should go into retained earnings or the balance sheet. It should not show up on the income statement. Then there were people that said it should be all-inclusive, regardless of what the item is, it should be the net income. So now we have a modified version, which puts some items out of the income statement, like other comprehensive income, and prior period adjustments. So it's a modified concept, modified and inclusive. Right? And it includes, the income statement includes both permanent and transitory components. So I would say continuing operations is primarily permanent, except for the unusual or infrequent items. Those could be transitory. Discontinued operations is transitory, and other comprehensive income is transitory. So it mixes them. It's a modified, all-inclusive concept because these items, and again, it's a statement of comprehensive income. Notice that net income, and remember what we said about comprehensive income. So that we have to talk a little bit more about this. But net income does not include other comprehensive income, but the term comprehensive income does. So if this is the statement of with comprehensive income included, and I'll show you some examples of that later, you have to be very clear not to get confused by the terminology. So if you're asked for net income, that would be anything from net income up. If you're asked for comprehensive income, it includes the other components.
So the value in those accounts are shown before taxes?
Which one's comprehensive income?
OCI and...
Yeah, OCI is going to be shown after tax.
After tax?
Yeah, after tax.
So how do you tax unrealized gain?
You calculate the tax on what would you have paid had that been sold. And you're going to find out, it's a very good question. How do you get tax on an item that didn't happen? How do you get tax on a transaction that is not the same as your tax return? Different sets of books. So we apply a tax rate against the foreign currency translation I showed you on Tuesday.
And if, based on that prediction, you're going to have an unrealized loss.
Unrealized loss, you get a tax benefit, just like a tax deduction. So if you have a loss on foreign currency translation, or an unrealized loss on a security, that's going to give you a tax benefit. It's a real good question, because how do you tax something that didn't happen for tax purposes? And that's exactly what happens in US GAAP. We create a tax that has nothing to do with the tax return, or very little to do with the tax return, as you'll see next semester in Intermediate 2. So we have totally different GAAP accounting. Remember we explained that there are different objectives? Tax returns have one objective, GAAP has another objective. So we're showing you, it's almost like a projection of what you're going to get after tax on these items. But again, just remember that net income is the bottom line for earnings per share. There's no earnings per share on comprehensive income. And the difference, sometimes the difference, what's the difference from income from continuing and net income? It's the discontinued operation. So the difference between income from continuing operations and net income is the discontinued. And you do see earnings per share on that as well. Discontinued operation, we're going to go into that in detail, but it would be where General Motors decided to sell off Oldsmobile, right? Or General Electric decided to sell off all their appliances. So it's a we'll talk about the criteria, but that's what a discontinued operation would be. And it is clearly separated because it's going to be something that is definitely not going to happen again, right? You're selling it off, so it's not going to. All right, so just some points of clarity. Earnings per share, you see it on continuing and net income. You sometimes see it on discontinued as well. And just to be sure, you have to know what statement you're looking at. Are you looking at a statement of net income or comprehensive income? Now, as we said, net income is, or I should say, income from continuing operations is primarily going to be permanent, but you have transitory components. So for example, here's an analytical issue for you. And this is an application. We're going to see a lot more of this now that we're starting to get into actual accounting. You know, we talked about this above and below the line issue. When we're looking at, for example, and you know, Tony, I'm glad you asked the question, because when you look at income from continuing operations, one would think that that's primarily what? Permanent. You would think it's permanent. And I've got to be very careful because accounting language is imprecise. So we say continuing operations, but there could be something up here that could relate to a restructuring, a corporate restructuring. There could be something up here that could relate to a sale of, for instance, shutting down some stores. So if Sears shuts down 165 stores, that's not a discontinued operation. Could it be a significant? Yes. So the trouble with accounting is we have these very discrete categories that conditions have to be met. And an analyst, that's why I say analytically, you could have problems when something doesn't necessarily meet the criteria for discontinued ops. Now it's stuck above the line, and it looks like it's a permanent component.
So is it principal based then, that Sears shutting down multiple stores?
Yeah, it's principles based, yeah, because it's a matter of whether or not the discontinued operation is a clean break of a very unique business, as we'll see. When we get into the conditions, and this is going to be the time where you're going to say, I don't like this stuff, or I like it. Because you're going to have to see conditions, like what's a discontinued operation? It's a component, it's got to have its own cash flows, it's got to be distinguishable from the rest of the business, it's got certain criteria that have to be met. Is it a major part of the business? What is major portion deal? And that's where we get into principles, which you're absolutely right.
So would there be any benefit to having it be discontinued?
Yeah, okay, this is a great question, because if I'm thinking about fooling an analyst, I may want to, you know, if it's up here, maybe they won't look at it. And maybe they'll think it's continuing. So when you do your forecast, don't forget, predictive ability makes it relevant. If I forecast using this number, it may include items that have transitory elements in them. Once I put it below, for example, if I had a huge loss, I may want to put it here as discontinued to get it out of the line of projection. So I may want to take a loss and move it down here if I could. I might want to take a gain and move it up here if I could, depending on my income reporting strategy. So yeah, there are benefits and advantages and disadvantages. And I think we've got the conditions now in practice that are pretty clean, and we'll see that. But we'll bring that up again. It's a real good question because this is where we had problems in financial reporting years ago until the standards became a little bit more, I think, accurate. So now that we move to this position, let me bring that up again. Now that we move to this position in the income statement, the analytical problem is that these unusual and/or infrequent items that is above the accountant's dividing line for typically permanent and transitory may include items that are transitory and may still distort the trend. And what do we do with them? Well, we are going to give you, get back to this question, we are going to give you enough disclosure. We're going to make sure that if these above the line items, unusual and or infrequent items, are not major in terms of being significant, we may bury them in other revenue and expense and then put them in a footnote. Why? Not going to influence your judgment. Not material, not relevant. Right? If it's not material, it's not relevant. And we are including it so we're being complete, but it's not relevant. However, if it is material, we break it out separately. So you're going to have a separate line item, and you see that line item I had highlighted in yellow. Unusual and or infrequent. Unusual and or infrequent. It'll be broken out separately with a footnote disclosure. Examples would be significant gains and losses from disposal of plant and equipment, restructuring charges, losses on asset impairments. If I have to write down goodwill, if I have to write down an asset significantly, or any gains and losses on major investments in other corporations. Those significant items are broken out separately. And that's what we saw up here in our yellow highlighted area. those would be broken out separately. The only thing is that you don't show the net of tax and you don't have separate earnings per share. Just to note that. So when you look up here, these are not net of tax. And no EPS. So when they're shown above the line, they're not shown net of tax, and you don't have any EPS. But if you're a financial analyst, again, now we're going to start getting deeper into this. You're a financial analyst, and you see this is the product that you're producing also as accounts. So let's say you're a financial analyst now. What does that red area tell you? Well, it's a red flag for the analyst, right? So what would an analyst do? What do you think? If you're analyzing this company, you want to project permanent components of income, what would you do with that highlighted area? Take it out, remove it, dump it below the line. So you can analytically restate this. So that's why we make that disclosure. So what I'm trying to do right now is make sure you kind of see that we break these out so that a user can modify those statements for their purposes. Although they don't meet the accounting conditions that we create as a profession, the marketplace, the financial analysts, the investment banks, the commercial banks, those analysts can easily take that piece and just move it down here, dump it in with the discontinued, and then make their projection. So they'll remove the transitory components where necessary. Just take it out and take it below the line and then project the new continuing operations. They can analytically restate them. So that's the purpose of the disclosure. That's the purpose of the disclosure. Okay. All right, so that's an overview. I'm going to just do a quick glance at General Motors financials, but any questions so far on this module? We're pretty much done with it. We're just introducing what the statements look like, just to make sure you know how taxes are distributed on these statements, what about these unusual items, what about the EPS, and when we look at General Motors, we're also going to show you a little bit more on the comprehensive income. All right, anything on that? Yeah?
Just to, so you're saying that red flag, basically, that you were just saying, is just something that when the analyst sees it would be put under discontinued operations?
Yeah, well, they would.
Just to occupy with that space
Yeah.
that they would have to have for whatever it was,
Yeah.
whatever the disclosure was?
Yeah, so I'm looking at this, and let's say I see, you know, what's in that red area could be, you know, loss on shutdown, Sears. They might lose 8 million, 80 million, whatever the number is, on store shutdowns. We just shut 165 stores. We're restructuring. That loss sits above the line. Now, above the line, it stays there as an accountant. But you highlight it, you disclose it, so that an analyst has the ability, if they want to move that below the line near the discontinued operations, and then their number of continuing operations is more consistent with permanent components.
Okay.
Right? That's the purpose of the disclosure. What I want to be sure, and that's a good question, what I want to be sure is that you understand the purpose of that disclosure. The idea is not to just memorize in this course and say that's where it goes. Why am I doing it? You know? Yeah, well, I have to. Why? Because that's what it said in the book. No, it's there so someone can use it to make a valid prediction.
Is that because as a county we look back at everything, and for financial analysts are just predicting the future?
Yeah, exactly. I mean, we are historical based. We're providing results that happen, but those results that occurred, when you look at a financial analyst model, it's generally a 5-year historical, and they project out 5 years. Now, I'm going to say something that may sound strange, and we'll see that now. Let's go into General Motors, and all right, so this is their statement. I wanted to mention that, notice that this is a combined, we'll spend more time on this later, but it's a combined statement of income and comprehensive, or I'm sorry, it's a single statement of income and a single statement of comprehensive income. So notice that this is only, if you look on top, this is only the income statement. This is only the General Motors income statement. When you look below, on the bottom, this is the comprehensive income. So I pasted them together. They would have been on separate statements. So let's take the income statement first. And on the income statement, you've got both permanent and transitory components. The net sales and revenues are permanent. You've got items of expenses that include permanent items, and also they've got maybe some transitory. So Tim, to get your question in more of an application, take a look at the goodwill impairment charge. That charge is a write-down of goodwill from one of their subsidiaries, $120 million. That is not a permanent component, but it's part of continuing operations. So that is disclosed in order for an analyst. Is that part of operating income? And look at the terminology, it's so sloppy. And it's just terrible terminology. So we're calling this operating income. You take a finance course, what's operating income? Earnings before interest and taxes. This makes no sense, but it's what we call operating income. We have a lot of flexibility in our terminology, and it's not precise. So this is not recurring. This is not a recurring item, and therefore it is transitory. Now, I've seen cases where impairment charges happen every year. Then what? Then it almost takes on a permanent flavor, and you might leave it into your projection. Right? So these are not hard and fast rules. They are flexible based on what actually happens. Now, we have another item here. We have a gain on early extinguishment of debt, and notice that happened a couple of times. So GM went out there and they paid off their debt. If you remember, their debt was, during the recession, was in kind of trouble, so I guess they were able to buy it back cheap. And then they have no discontinued operations, so that they've got their income tax and then their net income. Now, their net income, $9,268,000. There's also a non-controlling interest, so that's something you'll see in advanced accounting. Non-controlling interest basically represents if General Motors owns 90% of a subsidiary, the non-controlling interest share of income, that's the other 10%. That's the other 10%. So we split the income between General Motors shareholders and the outside shareholders. This used to be called a minority interest, it's now called a non-controlling interest. And then right below the line, you see earnings per share. It's going to be both basic and diluted EPS. And that is on net income only. We don't have any other components here. And it's also basic and diluted. Does anyone know the difference between basic and diluted EPS? Anyone see this before? That's pretty much a forecast, by the way. Diluted is a projection of what earnings per share would look like if we included all possible new share issuances. Like, let's say you had stock options. People have the option to buy the stock, but didn't buy it yet. What happens if they bought it? Earnings per share goes down. It gets diluted. So what diluted EPS means is, for example, GM's got $6.12 per share. That's their earnings per share. That's how much each stockholder that owns the stock now would get if they cashed in, hypothetically. That's the increase in the value of your holdings on a book value per share basis, not market but book. Diluted is $6. It drops 12 cents. Why? Well, we're assuming that there's like 30 million more shares out here now, right? Now, where'd you get those 30 million shares from? Well, they really didn't get issued. It's where if somebody converts a bond that converts the common stock. So let's say you're holding a bond that says, you got a General Motors bond, it could convert to 30 million shares of common. What happens to EPS if everyone converts? What if there are options? You have the option to buy the stock. You didn't buy it yet, but if you did, what would happen? So this is an as if, and you'll see more of this next semester. All right, so that's what we mean by diluted. Potential issuances of shares, what would be their effect on a potential issuance? What would be their effect? Yeah, that's the statement of net income. That's a separate statement. So that, in our example, is net income of 9268. When we look at another statement, now we build in the other comprehensive income. Notice that the statement of comprehensive income starts with net income, then adds or subtracts the unrealized items. So here's the foreign currency translation item we talked about on Tuesday. And this is a pension adjustment. You don't have to get into too much detail there yet, but there is a subtraction there. Other comprehensive income is negative. Yep.
So why would they include the 159? That was
Yeah, because those are, that information is only attributable, that 159 is attributed to shareholders that are not holding General Motors stock. They're holding shares of stock of a subsidiary company. So let's say GM buys a company, and I think I said 90% before, there are 10% of the market out there that still holds that subsidiary stock. And they don't have the right to GM, they have no right to GM's earnings, they have the right to the subs earnings, which you see. Yep.
So those controlling interests that you said before,
Yep.
how they mentioned, so it's basically the other 10% of the subsidiaries?
Those are the non-controlling interests.
Yeah,
That's
well,
non-controlling, yeah.
But it's basically just the other 10% of it.
Yeah, another example, GM owns 70%. 30% of those shares are still held by the other shareholders, not GM
Yeah,
shareholders.
so also that's just basically
Their share of
their
earnings.
books.
Yeah, of their subs earnings.
Yeah.
So for example, if, let's say you got GM and you got this sub, and let's say GM has 1,000, sub has $100, the net income combined is 1,100. But let's say GM only owns 80% of that sub. That means 20% of this is the non-controlling interest. The non-controlling interest gets $20. I'll be out of the way in a second. So when you subtract that out, the GM share is going to be 1080. Right, so that's the way it works. So actually, let me put it up here so you can see it better. So what happens is that if you've got, let's say you've got income, you've got net income, you got GM, let's say at $1 million, there's a subsidiary with 100, so that consolidated, you have $1,100 in income. But the problem is you only own 80% of that sub, and therefore the non-controlling interest share of net income is going to be 20, right? So you got $100 of the sub, they own 20%. That takes away from GM shareholders, so the net GM is going to be 1080. And that's the non-controlling interest is. It's their share of the earnings. By the way, the other way to do this is what? GM plus 80 of the sub, right? That's the other way to get that. So you could do in here, this is GM plus 80% of the sub. So that's the non-controlling interest. So that's what it means. You'll see that in mergers and acquisitions when you do advanced accounting. Right? Advanced accounting has that. All right, it's a good question. And that's why it's broken out separately. That's our starting point for OCI. Now, Any other questions on the non-controlling interest? So again, basically to think about comprehensive income, it's the sum of net income plus other comprehensive income. I know there are more adjustments here. Just another point on this, you have to realize that comprehensive income could be greater or less than net income, right? Depends on the other comprehensive income. Could be greater or less. All right, so any other questions? By the way, everything down here, we'll go back to GM. Anything down here is transitory, right? In the other comprehensive income, it's a transitory. All right. All right, so any other questions on the introduction to the income statement? All right, now, just a couple of questions. I'll go through these with you. I think some of them are, should be pretty straight up. Comprehensive income is including items that are excluded from net income. That is true. That would include those transitory components that we discussed. And we said that would be things like foreign currency translation, unrealized gains and losses, and various pension adjustments. Most items of operating income are permanent, and that is true. Had a discussion about this. What's the exception that we just discussed? What would be the exception? Unusual or infrequent items would be the exception. Unusual or infrequent items. Does U.S. GAAP require that we use a functional classification? First of all, let's think about this. What's the classifications on the income statement? What could that be? David. Classifications, what are they? There are two types. One is, remember? Functional, the other one is by nature. So the functional approach is required, but by who? SEC and IFRS. Okay, so that would be false. Number 3 would be false. All right, number 1, multiple choice. Limitation of the income statement. I'll give you a chance to get those out. Try number 1. So yeah, it is, A is correct. Limitation would be that, just get this off the screen, that it will depend on accounting methods. Evaluating past performance gives it relevance. Assessing uncertainties about future cash flows, predictive ability, and D is clearly predictive ability. B is confirmatory value. So B is confirmatory, right? Past performance. C and D are predictive ability. All right, so A is the limitation. By the way, the usefulness, of course, is here in B, evaluating past performance, confirmatory value. So the answer number 2 would be B. And finally, number 3, transitory. I mean, the only one here that's transitory would be discontinued. All right, so that is our introduction to the income statement. So again, focusing on transitory, permanent components, income statement formats. We'll do a little bit more now. Any questions before we move ahead to module 2? All right, in module 2, what we're focusing on here, really your takeaways for this module really should be the single and multi-step versions. Now, the single step is the least used in practice, does not really provide us with much information. Revenues and gains are grouped, and then from that we subtract the sum of losses and expenses. Doesn't provide us with much useful information. So here's an example of a single step statement. Notice that all of the revenues are really reported together. All of the expenses are reported together and subtracted in a single step. The double small so we can get it all up on the screen. Sometimes the income tax could be shown, so you could come up with an income before tax and show the income tax below this, but that's a typical single step. It is not very useful because it doesn't really give you any classification by nature. It doesn't tell you what's operating, doesn't tell you what's not operating. So just to understand why this is not preferred, it is not preferred because it doesn't give you any classifications by nature, so you don't see operating and non-operating items separated out. And you also don't see any functions. You know, they're there, but we're not telling you what's a functional item in terms of administrative, selling, and so on. So, for example, interest expense is non-operating, cost of goods sold is operating. Then you got your administrative and selling, but we don't break them out and provide the detail. Therefore, the multi-step, which is used by 90% of the companies in the US, will give you a much more detailed statement. It'll break out by nature, operating, non-operating, and by function, which again is only required by the SEC and IFRS. So here's an example. This is way over the top in terms of detail. But you got your sales, cost of goods sold. Cost of goods sold is part of operating, but it's also, if you think about it, it's part of manufacturing. If you had to classify it, then you got all of your selling expenses broken out separately, and then you have all your administrative. Then you have your income from operations, your other revenues and expenses, so you can see the detail. It gives you a lot of useful information, especially for the gross profit margin. Now, you can see that any income statement, especially the multi-step, it's a classified, there are really about 5 sections that you have to be aware of. You've got your operating, non-operating, your taxes, discontinued ops, and earnings per share. And in the operating section, this is going to be where, by definition, if this was done correctly, by definition, should be only your permanent components of income. It should only be your permanent components of income. So on page 4, you'll see sales, cost of goods sold, selling and administrative. This, if it is pure operating income, it should also be called earnings before interest and taxes, or EBIT. Earnings before interest and taxes, or as we might call it, EBIT. This is a key financial measure, and it should be shown this way if possible, because for financial analysts, EBIT is a critical measure for 3 reasons. Number 1, it reflects the core operations of the business so that it's of higher earnings quality, being pretty much the permanent components of the company's operations. It also assists you in analyzing a company regardless of the way the company was financed, so that the company have debt in its capital structure or not. If you have debt in your capital structure, it's called leverage when you borrow. If you take the debt out of the capital structure, you're unlevering this business. So you'll see that number 2 in the benefits here is that it allows you to compare the results of operations of companies regardless of whether they borrowed or whether they only used equity financing. Remember, we said that early on in chapter 4. You've got equity financing and you've got debt financing. So EBIT is before interest and before taxes. And therefore, in number 3, it provides you with a way to measure how much of the company's earnings are available to all of the stakeholders. You know, as a business, you have responsibility to distribute resources in 3 ways. Dividends to stockholders, interest to bond or debt holders, and taxes to the government. So if you can calculate earnings before interest and taxes, it provides you with that measure. So I want to go back to number 2 because this is important. This will be a way to compare companies regardless of whether or not they use debt in their capital structure. So I put together a very simple example. Let me see if I can get this on the screen just to illustrate this for you. And, okay, well, that's really large, too large, and there we go. All right, so when we look at the information that's up on the screen, I got 2 companies, A and B. B is totally equity financed. A is financed by debt and equity. So you got sales, cost of goods sold, operating expenses, and then interest expense. Pre-tax income, $150 for company A, $200 for company B. And the income tax rate of 21% would give a tax of 31.5 for A and 42 for B. So if you look at net income, company B looks like it is more profitable. Now, that is not coming from operations. In a sense, that's the net income or the bottom line. So it's the same thing when someone looks at, let's say, your ability to generate income. We're not worried about necessarily whether you borrowed money or not at this point. At some point we will, but not at this point. So when you calculate EBIT, you take the debt out of the capital structure. So what you would do is down here, you would just consider sales, cost of goods sold, gross profit, and operating expenses. And on an earnings before interest and tax basis, company A is more profitable. So that I would then be able to compare company A to every firm in the industry, regardless of how it was financed. And it is really incumbent on accountants to make sure that our statements are clear enough that it enables a company to be analyzed in this way, to strip out the debt, to strip out the debt component. And you notice that it just, again, obviously I made this in this way, so we would basically flip the ranking of these companies. So now, this is where I start. If I'm going to value your company, I'm going to look at your ability to generate income and cash flow based on your normal or your core operations. At some point, I have to look at the debt. It may not be right now, but at some point I do. If I was buying this company, maybe paying off debt might be part of the deal. Maybe I'm going to eliminate the debt completely. So I want to see how much you're going to generate in terms of the company's value. All right, so that's the importance of earnings before interest and taxes. Now, if you put this together properly, you'll also have a non-operating section. Oh, I'm sorry.
So it's not, so in the operating section, the interest and the taxes aren't included because eventually?
Yeah, so let's look at that for a second. So if I'm doing, let's go back, actually, let me go to here. So when I look at operating, the definition of operating income, that is not the same as income from continuing operations. Operating income may not be the same as income from continuing operations, because income from continuing operations includes interest, income, it includes those unusual and or infrequent items as well. So what we're talking about is a good question. What we're talking about here is the definition of a pure operating income, not necessarily income from continuing operations. So going back to what we had before, and this again these are good questions because it's imprecise. I can't tell you the definition of a company until I see their statements. In theory, it should be operating income should be before interest and taxes. But then we use the term continuing operations, and it includes everything else but. you know, so you don't know what's gonna be in there.
So, if I were to invest in a company stock, I would look at the operating expenses.
Yep, operating income. Yeah, I would look at I would start off by looking at EBIT, or operating income, and that would be the recurring source of earnings for this company. Then we have to look at the other items in case they have some future earnings implications. We don't know. But this is the starting point. So a big question on this, it is not necessarily income from continuing operations, it is operating income. Operating income.
Oh, wait, so
Yeah,
then
sure.
that would be in the, statement of comprehensive income, if you're including the,
No, let's go back for a minute. Let me, see if I can bring that back up on the screen. So let's see what Gene is doing here. All right, so look at General Motors' definition. First of all, it's wrong because they're saying it's operating income, but they're including an impairment charge up here. Right? So this is an imprecise definition. Then down here, they're calling this non-operating, but at the same time, interest income, interest expense would be here. So probably all you would need to do is just pull out this impairment charge and you get a better measure for operating income. Give you another example. Let's go back to our illustration back in Module 1. If you look at this current income statement format, this is income from continuing operations after tax. It's not operating income. Operating income would just be revenues and expenses, the permanent components. Continuing operations could include interest expense as well. It could include dividend income, interest income. So continuing operations is a broad term for everything except for what was discontinued. So continuing operations is everything except for what was discontinued. Operating income is before interest and taxes. So the term, and again, I can't guarantee, if you look at General Motors, I can't guarantee that's what you're going to see. And the confusion is basically built into the system, unfortunately, the way people define it. I mean, you see operating income for General Motors, that's going to be defined differently by Ford, and it's going to be defined differently by Honda. So everyone's going to have different components in what they call operating income. But the term continuing operations, this is clear. This is clear. It has to be anything except discontinued. And continuing operations could include items like restructuring charges and impairment charges as well. So you're not going to find a very clean definition in practice, that's for sure. All right, any other questions? See, now this non-operating section would include other revenues and expenses like interest. There's also a tax section, and I wanted to bring up this terminology, income tax provision. It's the same thing as income tax expense. So the term income tax provision is the same as income tax expense. And then earnings per share. Now let's take a look at another example. If we go to Amazon on the next page. So here's an application. Amazon, this operating income is absolutely correct. That is EBIT. So their operating income is in fact EBIT. There's no doubt. So this is earnings before interest and taxes. Below EBIT, you find non-operating items, such as interest, income, interest expense. some other items. Then you got income before tax. I'm going to tell you that this income before tax, this would be from continuing operations. Why? They have no discontinued. So this is really continuing operations. So I put this in here. I didn't anticipate the question, but I kind of thought that this would be important. And that is that operating income, or EBIT, they actually define it properly. And then the income before tax is income from continuing operations before tax. And then you've got your provision for tax. You can forget this for now. And then net income. All right, so does that help with kind of the difference between them? So operating income should be EBIT, and then other non-operating items should follow. Okay, so that's the way Amazon actually has a pretty good looking income statement. It makes sense. You know, it's the one that's kind of correct.
Do you have an idea what to be that other income expense?
Those are items that individually are not significant. So those could be gains and losses on sales of assets, gains and losses on sales of securities. Those could be unusual and or infrequent items that are not significant enough to break out separately. You'd have to read the footnotes to find that. All right, so let's keep going. So I'm going to try to tie this up a little bit more. So operating income is clean in this case. It's EBIT. Income before tax would be your continuing operations. And then you've got your bottom line net income. And then, of course, your earnings per share with basic and diluted. All right, next. It's a little small so you can see it. This is Anheuser-Busch InBev, which is from what I remember, it's a South American beverage company that was acquired by Anheuser-Busch. And this is a statement built under IFRS. Notice the slight differences here. Under IFRS, you put the footnotes in a separate column, which is always a good thing. But their statement, if you look at profit from operations before non-recurring items, those are going to be making up EBIT. So that's really operating income. And then you have these other. Pedro, here you can see this could be another. This could have been in, some of the other items also. Depends on how they classify. Then you got profit from operation. Now look at this one. This is where it gets even more confusing because that profit from operations is not EBIT. It's their definition of operating income. And then you have these finance. This is interest income, interest expense. And then you get your pre-tax income. So very difficult to find a precise definition. They're all going to look different. But an analyst knows what to do. That's the thing. So as long as you put the information out there, they've got it.
Professor?
Yep.
You said profit before tax would be continuous operation, or would just?
Yeah, I mean, that's
after
the only
tax?
thing, that would be before tax, yeah.
Before tax.
Yeah, it's pre-tax and then you got up. Okay, so,
Or would profit be continuous?
Yeah, profit is continuing operations after tax. After tax, yeah. Again, everybody's got their different terminology, but there's no discontinued here. We're gonna see some discontinued in the next module. All right. And that'd be profit. So you can see it. That's after tax. Now, the reason why I'm showing you lots of IFRS is because you're going to need to get used to seeing those statements.
So the non-reoccurring net finance, is that the only EBIT or?
Well, no.
Oh, I thought, yeah, I saw that.
No, EBIT is from,
Oh, okay.
it would be up on top before non-recurring items. And that should really be the pure EBIT number.
Net.
Profit from operations is convoluted in this case because it's got so many other factors in there that don't belong. So I would say again, is that if you wanted to call this EBIT, it's got to be profit from operations before non-recurring items. Probably would be the best definition of it. So the reason why I'm showing you this is not for you to memorize these statements, but to understand that in practice the definitions are not textbook. So you've got to work within the information that's provided and maybe understand, hopefully, that an analyst is going to move things around to make sure they conform to the definitions that they need to use for projections. Now, we're going to get, I mean, obviously these first couple of weeks, at least a month, maybe a month and a half, it's all going to be very broad. And, you know, you're not going to, in some cases you will, we are going to see that coming up in the next modules. But again, just a broad overview until we start focusing and narrowing in. The other thing too is that you could have a condensed statement where single or multi-step, you notice Johnson & Johnson, they're not breaking out selling general and administrative separately. They'll show you the details in a footnote, but if you look at this one, you know, where's the J&J operating income? It's not shown there, right? It just says earnings before tax, right? Earnings before tax. So it's got all kinds of information. It's got sales, cost of goods sold, gross profit, R&D expense, and probably up to the in-process R&D is what you would think of as EBIT, right? I don't know what's in other, could be, you know, that might be going up there as well if it's recurring. So you really don't have enough information here to get that EBIT number. There's not enough information. But the point is, Johnson & Johnson income statement there is very condensed. It's only probably about 10 lines if you exclude the earnings per share, and then they show you the details down on the bottom. So in the footnotes to the financials, you'll get details as to what is in the administrative expenses, what's going to be in shipping and handling, what's included in advertising. So whether you've got a single step or a multi-step, you can use a condensed statement. So instead of listing all of your SG&A expense, you can list just the word SG&A and then show the details in the footnotes. All right, so you know, again, unfortunately in practice, the terminology is not precise, but you need to know what goes into EBIT, right? The earnings before interest and taxes. The fact, what you need to take away is that the statement has to be broken up into continuing operations and discontinued. Continuing operations is everything except discontinued op. So continuing operations may sound strange, but it will include restructuring charges, impairment losses, also interest income, interest expense as well. So continuing operations is everything above that line that I showed you, and then below it is the discontinued. Then within continuing operations, you've got operating income, and how that's defined is up to the company. But the word EBIT really means exactly what it says. It's got to be earnings before interest and taxes. And within that, you have to keep thinking about what's permanent and what is transitory. All right, so to wrap this up before we go, let me just show you that this is a summary right here, okay, what goes into continuing operations, so you don't have to worry about, these are the definitions. And then finally here, let me just go over these with you in a minute, just to give you these solutions so you have them. Single step income statement format combines all revenues and expenses into a single category and all gains and losses into another, and that is false, okay? Because it really combines what? Revenues and gains, expenses and losses. So that's false. So it should be that's what makes that false. The next one talks about key performance measures on the statement of income include gross profit, net assets, and others. This is a trick question. Of course it's false because where are net assets? What statement? Assets minus liabilities, balance sheet. And EBIT is a critical measure. It's true, but not only because it provides that information to creditors, but also who else is going to be paid out of EBIT? Stockholders and the government as well. All right, and last, and we will get back next week. What is not a drawback of a single-step income statement? D is absolutely wrong. I mean, it doesn't misrepresent income, and let me just make this last statement before you go, and that is that EBIT, the single-step statement, I should say, will still show you enough information to get EBIT, but it's more difficult. Doesn't misrepresent, it just does not have those classifications. That's the thing, it's unclassified. Is net income the same if it's a single or multi-step? Yes. Right? So income's the same whether it's single or multi-step. So misrepresentation clearly is not complete.